Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly update with our friends at Strategas. Today, I'm thrilled to be joined by Strategas chief economist Don Rissmiller. Don, how are you doing this morning?
Very good, Russ. Very good to talk with you.
Thrilled to have you here. Obviously, a lot to unpack, and I want to start with kind of the big event over the last 7 days, which is the fallout from the failure of a handful of large banks, including Silicon Valley Bank. And from your perspective, I think the important question from here is what it means for the Fed and for the economy. And so I'd love if we could just get your high level take on that before maybe diving into some of the timelier data.
Sure, yeah, happy to start there. So, this is really why we watch leading indicators because we don't always know when something's going to break, but we know when the economy is getting into a vulnerable situation. So, I think the events of the last week are showing what the yield curve or money supply or some of these other indicators have been hinting at now for a number of quarters, which is we're entering a more vulnerable time. And so, there has been a patch applied to these specific entities. The new Fed facilities dealing with some of this is going to operate on the financial stability side of the mandate. But the data we saw on inflation says the monetary policy side of the mandate is not yet satisfied. So we're in this very awkward situation where you have essentially an easing to deal with financial stability, but you might have a tightening on monetary policy to deal with inflation. And this is not intuitive, but this is the situation the Fed is in right now. And so I think they should pause. I think it's worth spending some time to assess the situation, but I am not at all sure they will pause unless things get worse because they are focused on inflation. They're focused on the biggest inflation threat we've had in 40 years. And they're trying to do two things at once, trying to use two different tools, but this is very tricky, and I think we have to watch very carefully over coming days.
Right. I mean, in the past, these sorts of kind of financial shocks have led to an easing of policy at the Fed. But as you mentioned, CPI is still at 6%. It's still quite hot. And we got a CPI report this week. We got a PPI report this morning that was actually a little softer. What are you seeing on the inflation front? Do you think that the soft PPI report this morning does give the Fed cover to pause at their next meeting? Or do you think that they still think they have to hike from here?
I don't think that's enough simply because you had a big decline in egg prices. So there were some very idiosyncratic things in that report. The core CPI, I think, is attracting most of the attention, and I think rightfully so here. It's not that inflation is still going up. Inflation has peaked. We know that, and I think we can say that with some confidence. It's that it's not coming back down to 2% in a way that looks stable without the labor market flushing some more. And so until we get that story, and this is really the core services, ex-housing argument that's been made now for a number of months, that part of the picture is still showing some sticky inflation. So I don't think that the PPI by itself is enough for a Fed which was already agitated to pause here, even though I think there is a case for that. So I'm just trying to distinguish what I think the Fed should do, which is pause, from what I think they will do, which is hike 25 basis points at the next meeting.
Sure. And maybe the more dramatic move in what the Fed's anticipated policy is not what's happening at the March meeting, but what's happening way out into the future. So the peak Fed funds rate, at least by market-based expectations, has come down quite a bit. And then the expectation for when the Fed will eventually have to cut rates has been pulled forward quite a bit. How do you gauge that? And then if you could address, I think there are some people who think that falling rates, might be a boost to the stock market. But in this case, it would be for the reason that's not beneficial to risk assets. So could you maybe address what's happening on the longer end of the Fed fund futures curve, and then what that might mean for equity prices?
Sure. So when we look at history, it is true that when you have some financial event, often that marks the peak in, let's say, Fed funds or other central bank rates. And from there on, the Fed will cut. That'll provide liquidity. But a lot of that history is the last several decades when inflation was low. So you didn't have this conflicting goal of also taming inflation and making sure it stays down so that you don't just have to redo this a year or two from now. So Given that we've not seen a significant slackening in labor just yet, I'm concerned that history it has to be taken very carefully and put in the context of a higher inflation regime rather than a lower inflation regime. And so when we think about translating that to risk, there could come a time when we can say mission accomplished, inflation is now under control, it looks anchored. I think that's the entry point into risk assets. And this may be a hint that we're getting there, but I think this is still the early innings, and I think there's a lot that we have to digest between now and that entry point when the Fed declares victory. We're just not there yet.
Right. So a lot to watch over the coming weeks and months. And we really appreciate the time today. Hopefully we'll be able to talk to you again because this all is kind of unfolding under our feet as we speak. But Don, thank you so much for the time today.
Thanks, Ross.